Shinshin World View, know about the world together. Japan starts to liquidate its US debt, China continuously reduces its holdings. The US Department of Labor will release US CPI data for May. Although Wall Street institutions and economists are forecasting a further slowdown in inflation to 8.2%, it will remain at a 40-year high as US gasoline prices continue to set new record highs, and it is difficult to conclude that US inflation has peaked, driven by the prices of other factors of production. Goldman Sachs economists expect the Federal Reserve to bring the US economy to a serious halt in order to curb inflation. Former US Treasury Secretary Summers said on the 6th of June that US inflation was closer to its 1980 peak than expected. The US debt bubble has finally stung and begun to reveal its soft underbelly, with total US federal debt now nearly 12 times higher than in 1989, having reached a horrific $30.5 trillion on the 7th of June. There is growing concern on Wall Street that the Fed could drag the US economy into recession as it tries to tame inflation and bring a sell-off to the US bond market, with Wall Street firms such as Goldman Sachs, Citi, JP Morgan Chase, Bank of America and Fannie Mae and Deutsche Bank in predicting a recession in the next 2 years. Former Goldman Sachs CEO Lloyd Blankfein warned that the risk of recession was very high. Wells Fargo CEO Charlie Scharf said there was no doubt that the US economy was heading for recession, and former Fed Chairman Ben Bernanke warned that the country could face stagflation. An economic slowdown and high inflation. New data shows that a number of key economic indicators, including US productivity, factory orders and the University of Michigan's Consumer Confidence Index, have fallen significantly. Some economists also said that even if the US economy could emerge from recession in the short term, but high inflation has remained above 6% for the past 6 months, more than 3 times the target set by the Federal Reserve, and persistent supply chain bottlenecks, supply and demand imbalances and the regionalization of the global economy could snowball into a more serious crisis. Overlaid with sudden pessimism hitting US financial markets, the US economy is pervading the smoke of a pending recession. The continued bearish signals from Wall Street bigwigs on the US economy have also led to expectations that the Fed's aggressive tightening will continue to weigh on US bonds, diminishing their attractiveness relative to alternatives, as real yields on US bonds, which have been in negative territory for more than a year, have left investors losing money on a monthly inflation basis when buying US bonds. In a report published on the 3rd of June by renowned value investor Jeremy Grantham, quoted by US financial website Zero Hedge, it was noted that the continued high volatility in the US bond market may be festering, which will reprice the US bond market. As the Fed's rate hike process is far from over, with the official launch of tapering in June and the expected continuation of 50 or 25 basis points of rate hikes in the next 4 rate meetings, the unchanged trend of dollar appreciation is expected to further stimulate US bond yields to the upside, especially as the Fed's quantitative tightening, QT, from June 1 may also push up US bond yields and expose the US bond market to the risk of shrinking liquidity. On the 7th of June, inflation concerns pushed US bond yields to a 3.5-week high, with the yield on the 10-year indicator rising 8 basis points to 3%. The 2-year US bond yield rose 7 basis points to 2.7%, and the anti-inflationary expected 5-year inflation-protected bond break-even yield also rose to 3%, which will put pressure on the US Treasury to offer up to $65 billion of new 10-year and 30-year Treasuries this week. On June 5, through a new survey of more than 20 Wall Street traders, more than 90% of respondents identified continued high US inflation as the biggest tail risk facing the US bond market, such as a shift in investment needs as the cost of hedging rises and foreign bond yields increase. Will global official institutions provide more investment options to diversify US bond risk, at a time when issuance is surging? The widening of the yen's yield differential with US debt after it hit another 20-year low against the dollar on the 6th of June may be producing an unexpected loser US Treasuries, and it is clear that Japan will no longer be picking up the tab for the Fed's tapering of a total of trillions of dollars of US debt, which has suddenly started to increase its liquidation of US debt since entering June to maintain the yen and the JGB yield curve, and has contributed to the rise in US bond yields. Indeed, according to the US Treasury's latest report on international capital flows released in May, large US debt investors, including global central banks, have sold a significant $48.5 billion of US debt for the second month in a row in March, the largest monthly size in 3 years. Now not only Japan, which is an economic ally of the US, Saudi Arabia and Israel have continued to liquidate US debt, but also more than 10 major overseas holders of US debt, including China, Luxembourg, Switzerland, India, Saudi Arabia, Israel, South Korea and Australia, have each sold off varying degrees of US debt. For example, China reduced its holdings by $15.2 billion in March, and for the fourth consecutive month a total of $41.3 billion, the position fell to a 12-year low to $1.039 trillion, the largest overseas holders of US debt. Japan in March is a significant sell-off of $73.9 billion US debt, the strongest, and the momentum continues. Immediately afterwards, Quartz.com on the 6th of June cited the latest analysis by Debt King Gross and some US bond traders as saying that a reset of the dollar's role is expected to happen as the risk of a US recession looms and as the US debt deficit and inflation climb at the same time. The Fed has already started the process of contracting monetary policy to keep inflation down, but it still can't make the real yield on US bonds turn positive. With the real yield on US bonds in negative territory for a long time, it also means that the high inflation that far exceeds the US bond yield hedges the cost of issuing US bonds, which also makes it possible for cornerstone-level US bond investors to liquidate US bonds. Negative yielding US bonds, the waning attractiveness of US Treasuries relative to alternatives and efforts to de-dollarize global markets should see a plunge in foreign demand for US debt in the coming quarters, as highlighted by Goldman Sachs senior analyst Avisha Toka in an updated report published on the 2nd of June. As explained by the World Gold Council, gold is expected to return to its financial attributes when smart monetary authorities really need to address the ballooning snowball of US debt, high inflation and exposure to monetary assets. As the chart below shows, in August 1971, after the gold standard was abandoned by the US, the price of gold was $41 per ounce and by now it is at $1,845 per ounce, an increase of over 4.5%. Such is the power of gold. For individuals it preserves the wealth of generations, and for an economy it acts as an anchor of trust in international reserve assets and exchange rate markets. Shinshin World View, know about the world together.